Hey there. Lots of folks get confused about investing in the stock market. It can be tough to know which stocks are good for long-term gains and which ones are duds. To invest for the long haul, you need to pay attention to key indicators, stay focused on your goals, be disciplined, and understand your investment objectives. In this video, I'll tell you how to spot good long-term investments and what you need to look for. If you like the content, do subscribe the channel and like the video so it may reach to people looking for similar information. You should start with the basics. There are many factors that financial analysts look at when deciding which stocks are likely to do well over the long term. They look at things like a company's financial health and whether the stock is currently undervalued compared to its actual worth. Here are some tips for figuring out if a stock is a good value. Look at the dividend. If a company has a history of paying out and increasing its dividend, that's a good sign. It shows that the company's earnings are consistent and that it's financially strong enough to pay those dividends from its earnings or retained earnings. Some experts say you should look back at least 5 years, while others suggest looking back as far as 20 years to see if the dividend is consistent. Check out the PE ratio. The price-to-earnings ratio is a common way to determine if a stock is over or undervalued. You calculate the PE ratio by dividing the current stock price by the company's earnings per share. Generally, the higher the PE ratio, the more investors are willing to pay for a company's earnings. But a high PE ratio can also mean the stock is overpriced and due for a drop. A lower PE ratio could mean the stock is a good value and that its shares are currently undervalued. One way to see if a company is a good value compared to others in its industry or market is to compare its PE ratio with the overall industry or market. For example, if the industry has a PE ratio of 14 and the company's PE ratio is 10, that could mean the stock is undervalued compared to the rest of the industry. Watch for fluctuating earnings. The economy goes through ups and downs, and so do companies. One way to spot a good long-term investment is to look at the company's past earnings and its future earnings projections. If a company has a track record of steadily rising earnings over several years, it could be a smart investment for the long haul. Take a look at what the company's earnings projections are for the future. If those projections are strong, that's a sign that the company is a good long-term bet. But if the company is cutting its future earnings guidance, that's a sign of trouble and you might want to stay away. Avoid value traps. How can you tell if a stock is a good value for the long term or if it's a trap? One way is to look at some common sense principles, like the company's debt ratio and current ratio. Debt can be good or bad for a company. In good economic times, debt can help a company grow by financing that growth at a lower cost. But in tough economic times or when interest rates are rising, companies with a lot of debt can run into financial trouble. The debt ratio tells you how much of a company's assets are financed with debt. You calculate it by dividing the company's total liabilities by its total assets. Generally, the higher the debt, the greater the risk that the company is a value trap. Let's use a hypothetical example to illustrate how the debt and current ratios can be used to evaluate the financial health of a company. Let's say company XYZ has $500,000 in assets and $200,000 in liabilities. To calculate the debt ratio, we would divide the total liabilities by the total assets. This means that 40% of company XYZ's assets are financed with debt. Generally, a debt ratio above 50% is considered high and could indicate that the company has a significant amount of financial leverage. Another way to see if a company can handle its debt obligations is to look at its current ratio. This is the company's current assets divided by its current liabilities. The higher the ratio, the more liquid the company is. Let's calculate the current ratio for company XYZ. Let's say they have $300,000 in current assets and $150,000 in current liabilities. To calculate the current ratio, we would divide the current assets by the current liabilities. This means that company XYZ has a current ratio of 2, indicating that they have twice as many current assets as current liabilities. Generally, a current ratio above 1 is considered good, as it indicates that the company has enough liquidity to meet its short-term obligations. By looking at these two ratios together, we can get a better idea of company XYZ's financial health. In this case, a debt ratio of 40% is relatively low, indicating that the company is not overly leveraged. Additionally, a current ratio of 2 indicates that the company has enough liquid assets to cover its current liability. Overall, This suggests that company XYZ may be a good long-term investment opportunity. This brings us to the end of the video. Give a thumbs up if you liked the video and do subscribe to get a notification for upcoming videos. Goodbye and have a nice day.